Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In this edition of the Moneymakers Investment Trust podcast, I'm joined by two guests. In a while, you'll be able to hear my recent conversation with Maggie Fanari, who was brought in 2 years ago as the CEO of RIT Capital Partners, originally founded by Jacob Rothschild back in the 1980s. But first, in a conversation I recorded earlier this week, I was joined by Laura Elkin, who is the manager of AEWU UK REIT, ticker AEWU, a listed investment trust that's been on the market for nearly 10 years. It listed in May 2015, so coming up in a couple of weeks' time to its 10th anniversary. Laura has been involved in the management of this trust since the beginning and as the lead manager since 2022, the last 3 years. So, Laura, we've spoken before. I have to declare an interest. I am a shareholder in this trust. And what I haven't mentioned so far is that, according to my numbers at least, you are the best performing, still surviving UK commercial property trust, which is some credit to you, of course, and also you're the only one in your sector who's actually sustained their dividend through thick and thin, and we've had quite a lot of thin in the last 10 years as well, including the COVID pandemic, when nearly every other commercial property trust was forced to cut its dividend. So that's all the good news. Now let's talk about where we are at the moment. You've just put out your first quarter results for 2025. Perhaps you could just tell us what the headlines of that particular story are first, before we get into it.
Yes, thanks, Jonathan. And hi to everyone who is joining. We put out our year-end shareholder update this morning. Please have a look at our website if you haven't already seen that. We declared our 2p per share per quarter dividend for the 38th consecutive quarter. So as Jonathan has mentioned there, just highlighting how stable that dividend has been over a long period of time. And of course, one of the highest dividends in the investment trust sector. We also announced this morning a NAV total return for the quarter of just under 2%. Just continuing for us really a sort of fairly stable increase in valuations that we've seen over the past couple of quarters. And really proud of that performance. The commercial property market as a whole has been returning some fairly flat performance in recent quarters. So yeah, really pleased with how we've managed to continue to push on our NAV using strategic sales and also our asset management.
Right, so we'll dig into that in a moment. There has been a sense that there has been some kind of modest revival in the commercial property investment trust sector in the last couple of quarters, I'd say, since the autumn last year. Now, a lot of that's been, of course, partly driven by consolidation going in across the sector. We've seen a lot of UK listed commercial property investment trusts either disappear through mergers or moving across to the main market, abandoning the investment trust sector. So if we look at the question of what discounts really are prevailing in the commercial property sector, those trusts that have disappeared or done deals have tended to go out, I think, somewhere in kind of high single-figure discounts to their stated NAVs. Your trust is trading at a discount of somewhere a little bit below that, so 6, 7%, something like that, maybe 8% at times. What do you say about the question of valuations across the sector in the light of all that activity?
I think there are clearly a few cases where valuations could well be misaligned, but I wouldn't necessarily point to that as being the main reason for these quite long-term now subsisting discounts. I think there's perhaps a perception with some of the REITs that they haven't necessarily been fulfilling their strategy or haven't been maximising the value of their portfolio. And that's perhaps one of the biggest reasons for those discounts persisting over such a long time. And I guess it's perhaps unfortunate for the investment trust sector that a lot of private capital is therefore seeing opportunity and coming in and being quite opportunistic about that.
So you wouldn't just blame interest rates. It's not just interest rates moving. Obviously, they moved up, and then we've reached a period where some people are hoping at least that they might come down. It's not just about interest rate movements. It's also about how those portfolios are being managed.
Yes, I think so, because there's clearly a range of exposure amongst those trusts in their different debt facilities and in their different strategies. So I wouldn't point to that, I think, as a sort of single cause for what we've seen.
If we look at how you've managed to both sustain your dividend and as you say, slightly grow your NAV in the last quarter or two. You've talked about asset management being the key to that. Perhaps you could describe exactly what you mean by asset management and what in that area you've been doing, which has actually added some value over the last couple of periods, say.
Yeah, absolutely. So we often describe asset management as being one of the main drivers for our strategy. It's really, really important to us. Just as a reminder for everyone listening, we are a value strategy, and that often sees us buying counter-cyclically, buying high income, buying across sectors as we find value at any given time. So yeah, asset management, and we have our own in-house asset management team, really drives our income, keeps it high, and maximises the values of our property from time to time. We announced this morning in the announcement that we added just under 650,000 of new income by way of lettings during the quarter. So that is just a really high level. And I think it's really interesting to try and make people aware that clearly, from a kind of macro and political position over the past quarter, you would say that there's certainly been various moments of upheaval. And even during those times, and again, if you look back over our historical track record, we've been running for 10 years now, clearly a lot of events during that time, we are still able to maintain a lot of asset management with our tenants. So to continue to work with our tenants to drive income and to drive our performance.
And can you give a couple of examples of what that actually means in practice? What have you done that's added value?
So one of the things that we have announced this morning is that on a block in central Bristol that we owned, probably going back about 2 years now, we had a significant part of it let to Wilkinson's, clearly the retailer who failed going back some 2 to 3 years. We announced this morning that that space is now fully let. So we have done a letting to some leisure tenants to take that space and achieved that in line with our ERV, our estimations of rental value. So really pleased with how that has performed. And I think it's kind of indicative of what we're seeing, a real resurgence in the retail space. Clearly that sector was quite unloved for some time and very much struggled. Another example in the retail sector that we announced was a re-gear with Next that we completed on their lease on the asset that we own in Bromley. We knew that they were trading very well from that unit. And this is a metric that we often look for when we come to purchase assets. So when we come to buy a retail asset, we're not simply looking for, is it priced well? And of course we are looking for, is it priced well? But we are also looking to see how that tenant is trading from that unit. If they are not trading well, then we would probably not look to buy that unless there was opportunities for alternative use there. Now, it turns out we knew that when we were buying this unit that Next were trading very strongly. And we have owned the unit for about 2 years now. And we've had almost effectively since we bought the unit, an ongoing conversation with Next where they were asking us to extend their lease for a 5-year period. So we have announced this morning that we have completed that transaction with them too.
Okay, so that's good news. And if you look across the sector as a whole, though, you say in your announcement that you are excited about current opportunities. I mean, that's the kind of thing that managers often say, but perhaps you could justify that for me. What's exciting about the current opportunities and where are you finding them? Obviously, we know that the office sector remains quite tricky, and that's not a big part of your portfolio at the moment. But where are you finding the best opportunities? Is it still in the same old areas of industrial and so on? You mentioned retail just now, but what are your thoughts about those different sectors?
So for AEWU, we really are seeing that the commercial property market is offering a lot of exciting opportunities at the moment. And for me, there are 2 strong indicators of this in our pipeline at the moment. Firstly, we're at a point in the general property value cycle across the market as a whole, where values are at their lowest point since our IPO. So what we're saying is that now is effectively one of the greatest opportunities that we've seen in the lifetime of this company to buy across sectors, particularly in a value strategy. So to buy those high yielding assets with low capital values that will provide our opportunities for outperformance. That is a really exciting point for us to be at. So we're seeing a lot of opportunity in our pipelines at the moment. Combined with that, it's often an interesting point to make that at times of uncertainty, and clearly we're seeing some at the moment in respect of sort of macro level and in politics, times of uncertainty can create greater opportunities for the acquisition of mispriced assets, which, of course, as a value investor, is what we are looking to do. Across the market as a whole, investment volumes have increased somewhat from where they were a few years ago, but they still remain depressed if we look at a sort of 10-year average. More transactions are taking place with limited marketing, so there's less transparency in pricing. And that does drive a greater number of mispriced opportunities in our pipeline. So we think it's a really exciting time to be buying commercial property at the moment. Now, I'm very happy to be able to talk to you about different market sectors because, of course, we are a diversified strategy. And for me, the beauty of diversification is that it allows us to capitalise on movements between sectors at various points in the cycle. The sectors don't move together through the property cycle. They can move counter-cyclically. And if you're not a diversified strategy, then you simply don't have the opportunity to capitalise on that. So, of course, we do, which means that really at any point in the cycle, there is generally somewhere in the market that we can look to make money. And we think that's really the key to how our 10-year track record of outperformance has been driven.
Right, but you haven't said exactly where you think those opportunities might be. Are you being coy for commercial reasons, are you?
I'm not. No, I'm more than happy to talk about that. Our strategy is fairly sector agnostic. So we look across the market as a whole to see where we find value. Now, of course, that sees us sort of various trends within the market, see us taking sort of sector themes from time to time as we move through the cycles. We are still seeing a lot of opportunity in retail, and that sector from an investment perspective is not quite as unloved as it was a couple of periods ago when we were buying a lot on the high street. But you will have noticed that back in March, we announced the purchase of a high street retail asset in Hitchin for a very high yield in an affluent location with tenants that are trading really strongly. And the yield on that purchase was around 8.5%. So a really strong example of something that's very suitable for our strategy that we can buy at the moment in that sector. We are still seeing interest in the industrial sector, and actually an example of why that is was announced in our shareholder update this morning. So we have owned for a number of years an asset in Runcorn, where we took back a unit from a tenant about a year ago, with the tenant previously paying us a rent in the region of about £6.50 per square foot. We refurbished that unit and we announced this morning that we had been able to let it at a rent equating to £8.50 per square foot. So just really still seeing some strong rental growth within the industrial markets.
You also mentioned in the announcement that you're so excited that the Trust is considering looking to raise more capital, including possibly some new equity being issued. Can you elaborate on that any further?
I think I'd just point to our pipeline really and say that we are always thinking about opportunities to grow this trust. When we look at our pipeline, and sometimes as a manager it can be a little bit frustrating to see assets trading that we would love to have in our portfolio that we think would present really great opportunities for both sustaining high levels of income and also capital growth. And to not have the ability to move on those assets, as I say, is sometimes frustrating when the only ability that we've got is to recycle capital. And of course we do that. But yes, from time to time, we will be thinking about ways to grow the trust, really using sort of any mechanism that is in the interest of our shareholders.
Right. I mean, one obvious question I guess I would have to put you is the market capitalisation of your trust is 160 million. And that is partly by choice, but also perhaps as a result of that, you're looking for deals in the region of less than 15 million. Do you think that means there is perhaps scope or even a need for consolidation in the sector involving yourself, either as a consolidator or possibly being at risk of being jumped on by somebody else, given your excellent track record?
I think there is clearly a theme of consolidation within this sector at the moment. And clearly, we are one of the smaller companies. We do have one of the strongest track records. So does that make us more or less vulnerable than others? I guess time will tell. But what we would like to be able to do is to capitalise on our strong track record now, which, as you've said, we have had for close to 10 years. And yeah, really hoping that that performance is what shines through.
So let's just suppose, for the sake of argument, there are some trusts that pursue broadly similar approaches to you, which haven't performed as well. If you were to merge or take over or continue to manage a larger vehicle, would you be changing the strategy at all? Obviously, you maintain, I think, your diversified approach, but would you be actually increasing the kind of size of lot that you're investing in, or just doing more of the same? In other words, is the market opportunity higher up the asset size chain, if you like?
I'll sort of see that as two separate questions, really. Firstly, on our strategy, clearly our strategy has outperformed. We think our strategy has provided a very resilient source of income and also capital return as well. So we also believe that we can continue with that strategy looking forward. So I guess whatever happens to this trust, we wouldn't be foreseeing a situation where we changed the strategy. Turning to the lot size question, we have an investment restriction which caps us at, I think it's 15% of gross asset value in terms of buying assets. So that's a level of currently around 21 million at the moment that we can't exceed when it comes to buying assets. Now, the way that things have stood in our pipeline over the past 10 years, I haven't felt that that has been particularly restrictive on us. But would it be nice to have that door opened to us in terms of buying some slightly larger assets from time to time as they cross our desk if we think they look attractive? Yes, I would like to have that opportunity, because I think the more open we can be with our pipeline, the larger the pool is, the greater the number of opportunities that we're going to find. Now, am I suggesting in that we're going to move away from a smaller lot size strategy? No, I'm absolutely not. But I guess perhaps just modest or even incremental growth could be helpful in just slightly increasing that level that we are able to access.
Another thing you could do, I guess, is you could increase the gearing on the trust. Do you have the capacity to do that? I think your gearing is, well, you can measure it in several ways, of course, net or gross, but it's somewhere in the 20-25% range, I think. Is that something you could increase if, for example, the opportunities of equity issuance or consolidation were not immediately available, given your views about how many opportunities are out there?
So our current loan facility and investment restrictions allow us an LTV of 25% of gross assets, and that is where we are at the moment. We would not look to increase that. I think we're pretty happy that that acts as both a boost to our performance, but also sits there at a fairly modest level that our shareholders can be comfortable with and not worry about. So I think it's fair to say that we wouldn't look to increase that simply just to access pipeline, no.
Okay, so I'm still hearing a pretty positive story. I guess I have to ask, therefore, what are the major risks to your continued success, if I can put it that way? I mean, for example, we know the budget has had an impact on consumers, certainly on consumer confidence. You've mentioned the uncertainty, and with the tariff dramas going on, although you're a UK commercial property trust, that could have an impact as well, indirectly at least. What else would be on your mind? Interest rates could, of course, go up, I guess, as well, though not expected right at the moment. So what are the major risks to your continued superior performance?
Clearly, one of the biggest ones out there is interest rates. And as a company, we have our refinancing coming up in 2 years now. So we are very mindful of that. We have our own in-house debt team here who know lenders across the market and have expertly negotiated both of our previous loan facilities with the great results that we've seen. But of course, conscious of this refinancing need coming up in 2 years, and we have educated ourselves on where we expect that refinancing rate to be based on today's rates. Now, despite our announcement this morning at 1.7 pence of earnings, which was just simply as a result of having made a sale at the end of last year, we have worked really hard to grow our income over each year for the past 3 years to a level that now exceeds full cover for the year ending March 25. So in short, as we project it today, we believe that our portfolio and our strategy can deliver enough income to compensate for that increased financing cost that we will face. And based on today's rates, we think that we will be able to refinance, and in effect, it will be a materially earnings neutral event. But of course, that is still a concern because there is another 2 years for rates to move, and we will see how they go. I suppose that they could also come down further from where they sit today, which is very much our hope. In terms of other risks, clearly, we've both touched on some uncertainty out there. We've got Trump's policies, we've got businesses facing the national insurance increase. And of course, all of these things need to be closely watched and discussed with our tenants. But what we really see across most of our tenants is a level of resilience, because these are businesses who have faced the pandemic. They have faced high levels of inflation in the UK and particularly faced energy cost inflation, and yet they remain trading. Most of the sort of assets bought in the last couple of years have been appraised off that sort of harsh backdrop. So they are, as they stand, resilient businesses. Now, not to sound at all flippant about this, but if tenants are lost, then that can be something that is managed. All of our assets are well located. We have done our homework in terms of their tenant demand in each of those locations. And as I've pointed out with that example in Bristol, where we lost Wilko's going back some 18 months, that unit is now fully let. And actually the example that I've set out in Runcorn as well, the reason why that unit became vacant is because a tenant was lost through insolvency as well. But clearly that outcome has increased the rental tone on the whole estate from £6.50 to £8.50. So we are now seeing some really strong valuation uplift on that asset because of a tenant insolvency. So yes, clearly this is something that needs to be kept a very close eye on. But if we own strong assets, then really there should always be a fundamental level of demand there.
Right, so there's always a risk of voiding and so on. You say very accurately that you've maintained the dividend throughout your history as listed, but it hasn't been covered completely for a period. Are you saying that you are confident that you can continue to see the dividend covered in future, looking, say, ahead 2 or 3 years, with or without asset sales, if you like, or refinancing?
Of course, our dividend policy is set by our board, so I can really just comment on the company's earnings. Now, clearly, in respect of the board's decision on dividend policy, our board have taken the decision to support our dividend over the long term, and that's clearly a strong message to the market there. In terms of earnings, though, the company's level of historical dividend cover since IPO averages at 94%. So you're absolutely right that we haven't been 100% covered over that time frame, but 94% still represents a very strong level of cover. Now, what we operate at AEW, and hopefully I've sort of made that clear in stressing very early on in this call about our active approach to asset management, we will actively manage our assets, and that includes selling assets when we feel that the values have been maximised. And clearly we did that at the end of last year with Coventry and are going through a process of reinvestment at the moment. So there will be times when our dividend isn't fully covered, but what we have hopefully demonstrated over many years of running this trust is that we use the capital profits from those sales, of which we are holding a significant amount of reserve, to top up the dividend from a total return perspective at times when income does not provide 100% cover. And clearly our board have backed that approach too.
So my final question to you, Laura, is you produced some, I think, excellent returns over some very difficult periods. But we have seen quite a lot of trusts leave the sector, as I mentioned earlier, either by merger or consolidation or selling, being bought by other people. Or more recently, we've seen some trusts migrating away from the investment trust sector, either to the main market or some other segment of the market. Obviously, if you were to consider that, that would be a matter for the board. But from your point of view, do you have any views on whether that would be an advantage or a disadvantage to you running the portfolio?
That's an interesting question. I'm going to say that I think both us at AEW and our board as well, both have a strong belief in the company's delivery of its income stream and its dividend to our majority retail shareholders. So the company's shareholding now is around 60% held on platforms and by pure retail holders. Clearly, given the share's strong rating compared to NAV over the past couple of years, we are viewed as being one of the more robust companies out there by those holders. And I think it would be a shame for those holders to lose the dividend that we have continued to pay for such a long time.
Right. So that says to me, I'm putting words into your mouth, so please correct me. You're saying you're quite happy to stay as an investment trust as long as you're carrying on doing what you're doing at the moment. In other words, you're taking advantage of the investment trust structure with the benefits that adds for the moment.
Yes,
at least.
Absolutely. Yeah, we really enjoy running our strategy. You know, it's something that we all feel quite passionate about in-house here. You know, we're all property geeks and we all get very excited by opportunities in the commercial property market. So is this something we want to carry on doing? Yes, it absolutely is.
Okay, so let's bring it to an end there. Thank you very much, Laura, for your update. That was Laura Elkin, the manager of AEW UK REIT, a diversified commercial property trust that this week produced its latest quarterly results and boasts currently just under 8% yield, which is something it's maintained throughout the most difficult periods of the last few years. You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. I've had the chance to catch up and talk to Maggie Fanari, who is the CEO of RIT Capital, the well-known, long-standing investment trust that was founded by Jacob Rothschild back in the 1980s. He obviously no longer with us, sadly, but Maggie Fanari was appointed CEO a year ago. Formerly, you were working as a senior managing director of a very large Canadian pension fund, the Ontario Teachers' Pension Plan, had some $300 billion of assets under management. But I wanted to start, really, if I may, by asking you about how you came to be the CEO. So I think it's fair to say you were on the board of RIT for a number of years, and it was only 12 months ago that you became the CEO. So how did that come about?
Thank you, Jonathan. It's a pleasure to be here today. I actually got to know the RIT team many years before I joined the board because at Ontario Teachers, I was investing across private and public assets globally, and RIT was coming up in many of the same transactions and investments that I was looking at. So I got to know the RIT team that way, and I was just impressed by the brand and the power it had to be investing alongside many of the deals I was investing at the Ontario Teachers Pension Plan. And then subsequently, I joined the board and ultimately CEO of the company. And having known the strategy and the team quite well, it just seemed like an appropriate time to join the firm, knowing that I could make a positive impact.
Right, so RIT, as you say, much smaller in global terms, in terms of size, compared to the pension fund you were involved in before. Market cap now is around, 2.7 billion, something like that. So a lot smaller. So you must have seen a lot of upside there. I guess the interesting question in a way is, you observed RIT over a number of years as a non-executive director, and you saw this period when it's moved from being consistently rated as a premium to trading at a discount, a number of well-publicized issues. So, if I can put it this way, how would you describe what has gone wrong with RIT in the sense that the change in the rating, the change in the performance has been not as good as in the past? How would you characterize that from your previous position, and what did you think, or what did the board think you would be able to bring to turn that around, if that's the right expression?
Yeah, thank you, Jonathan. I mean, 2 years ago, the trust had a challenging period of performance. And just for context, the prior 2 years were an exceptional period of performance for the fund. And between 2022 and 2023, some of that was given back. But over the last decade, the NAV performance for RIT has been close to 110%, so nearly doubling shareholder capital. But where we could have done better and where a lot of effort has gone in over the last 12 months is really looking to improve our communication and our transparency with the market. So we've looked to make our story and a lot more information around the company much more accessible to investors. We've changed our website, we've improved our fact sheets, we've provided a lot more disclosure in our annual reports, and we've become much more accessible to the market. We hired an investor relations firm called Cadarn to help us meet as many investors as possible across the UK, and also importantly, we just reported our annual results a couple of weeks ago, and our returns from an NAV perspective were 9.4% and much closer to our long-term average of 10.5%.
I guess the question is, if you're saying that you put a lot of effort into the communication and transparency, and the implication of that is that there wasn't enough before, or at least that I guess there might be something to do with the fact that Jacob Rothschild, Lord Rothschild, is no longer with us. Because I think, well, having worked as an investor at a wealth management firm, for example, RIT Capital was always seen as a very reliable performer over many, many years. You had this mantra you were going to capture 70% of the upside and only 30% of the downside, or whatever it was. I don't think you're highlighting that anymore. So how did the brand, if you like, lose its luster? Because that effectively is what you're saying. If communication and disclosure is the answer, that must be that something was not quite right before.
Well, I think globally, the brand continues to open any door from an investment perspective, Jonathan, and that continues to be the case. We also recently have made some new investments with some very impressive companies, but I think going back to communication, there were questions around our private investments, going back to the point on transparency, and there needed to be improved understanding around the maturity, the type of companies that we owned. Many investors, as an example, if we look to demystify some of the misconceptions around the privates portfolio, that a lot of it had been invested in the heydays of 2020 and 2021. Actually, the majority of our investments were made pre-2020. Those are well diversified by vintage, by geography, and by sector. We also look to take down the percentage of our privates allocation from the mid 40s. Our target somewhere between 25 and a third. We landed at a third last year. It will likely, given the maturity of the portfolio, come down over time back to our historical average in the 25% to the high 20s. And also this year, we look to expand the disclosures around the look-through positions through our fund investments to demonstrate the maturity of the companies that we own indirectly through our funds in a more meaningful way. And some of the names that came through are household names such as Stripe, a very mature company. Another company that came up is Wiz, the cybersecurity company that was recently acquired by Alphabet, that was just recently announced. So what we were looking to do is really expand and provide and educate our investors really around what is in the RIT privates portfolio. Who are these amazing partners RIT has been investing with for more than the last decade? So be that Thrive, Iconic, Green Oaks, very well-known brands, particularly in the US. These are very seasoned investors who started their funds more than a decade ago, and most of them are managing today more than 20 billion in AUM.
Okay, so there's been a kind of strategic shift. I can see that, and communication goes hand in hand with that.
As does the performance.
As does the
all
performance.
3 of our investment pillars this year producing positive performance, leading to our 9.4% return.
Okay, so I should say your quoted equities portfolio, you have these private investments, and then you have what's called uncorrelated strategies, which are effectively, well, you could perhaps describe them, but they're designed to dampen the volatility of the performance. Is that right?
That's right. They're designed to produce steady pace of returns through any market cycle, be that through credit funds or absolute returning strategies.
So would you say that the reason that the trust has moved to a really significant discount by its historical standard is mainly down to perceptions of what's happening in the private equity space, or is it actually something about the brand of RIT itself?
It's a combination. So in 2022, overall, the discounts in the investment sector have widened. If you have private investments, they've widened further. But as we all know, discounts have materially widened in the sector. There have been also capital outflows out of the UK, particularly between August and October of last year, where we saw increased selling pressure around concerns around CGT. And then we have responded to investor comments around performance, again, going back to the strong performance that came out from last year. Greater transparency around our privates portfolio, showing the strength and maturity of our privates portfolio, and also investor engagement, and really looking to bring on new investors onto our shareholder registrar as well.
And what sort of time frame are you giving yourself to see the improvement, not just in performance? Obviously, you said that was a decent year last year, but in terms of the discount, which is what currently still, according to my data screen, it's about 28% at the moment, which is still very, very wide.
Yes, it is. Our discount has been as wide as 30%. It's been as low as 20% over the last 12 months. We clearly look to continue to push on all drivers. So be that performance, be that enhanced transparency with our investors, really getting our story out to the market and meeting with as many new and existing investors as we can. And then obviously continuing with our buyback program where we've bought back more than 8% of our share capital.
Right. So how would you define success? In other words, what would RIT need to look like in order for you to be able to say this has clearly delivered the success that obviously you and the board want?
So that would be returns aligned with our long-term average, having closed our discount, and would be two of those elements.
You also mentioned in a recent presentation the issue around cost disclosure. Now, that's obviously a very live issue in the UK as far as many alternative investment trusts are concerned. There was what appeared to be a kind of breakthrough on that back in the early autumn last year, but it's still now up in a state of limbo, shall we say. We don't quite know what the final regime is going to look like, and at the moment it's not looking quite as positive as it did back in, say, September, October last year. How big a problem is that for you, RIT?
So I think that's as much of an issue for us as it is for many in the sector. We're firmly opposed to the current proposal by the CCI regime. We've been working alongside the AIC in the sector looking for a better outcome to provide the right level of transparency, but also clarity around what are the costs in the investment trust sector.
So you actually had evidence that this is reducing the demand for your shares effectively, particularly in the wealth management community.
Yes, because it creates confusion. One example would be more than 12 months ago, we were delisted from Fidelity's platform, and then we were reinstated last fall, and we clearly saw increased trading volumes on the back of that as our product became more accessible to a wider group of investors.
And what does your share register look like at the moment in terms of the breakdown between kind of private investors and institutional or wealth managers or others? Obviously, there's a family legacy shareholding of quite significant, but what is the breakdown? And do you have a target for where you might be going?
So the combination is between long-term institutional investors and family. So that's about 75%. And the remaining 25% is with retail platforms.
Right. And so is it part of your ambition to increase that proportion, or is it just a question of stimulating demand across the whole market?
It's really about stimulating demand across the whole market, although we acknowledge that in the past we haven't engaged as much with the likes of Interactive Investors and AJ Bell, and we've been doing a lot more of that, a step change in our approach from last year, and we'll continue to do so into this year as well.
So looking back now to over the last 12 months, what is it that you have been able to do and what has actually changed as far as the management of the trust and the management firm is concerned? What's actually changed?
It's been a combination of factors. We've been able to bring on a couple of very talented people within the investment team to complement the existing team across public markets, which has been helpful in credit as well. So we've been able to attract some very strong talent into the organization. We've been able to embrace being a much more transparent and communicative organization across the board. And we've been really also quite active and proactive around our privates portfolio and realizing assets within that portfolio. So last year we realized about 13% of our portfolio, which was nearly double what we had done in the prior year. And in aggregate carrying values at above NAV, again demonstrating to our shareholders that we're able to realize assets above NAV, but also generate positive returns from our portfolio.
So the fact that you are reducing the proportion of private investments, what's the driver there? Is it about potential returns vis-a-vis, say, public equities, or is it about changing the risk profile, or is it about just these communication issues?
It's a combination of those factors. So the first is our commitment to reduce our private investments to 25 to a third, which is more aligned with our historical average. The second one is actually just the relative maturity of the portfolio. Many of the companies in our portfolio are quite mature, and we're seeing increased realizations. As I said, about 70% of the portfolio was invested pre-2020. So we're just going through the natural cycle on that front.
So if we look ahead, switching to actually the kind of prospect for the various asset classes in which you're invested, obviously you're an all-weather kind of portfolio in a sense. You want to deliver consistent returns across the cycle. But how do you view the current environment? Obviously, we've had President Trump coming in, a blizzard of announcements, potential trade wars, and of course many other factors thrown into that, including Ukraine and the Middle East and so on. So what is your perception of how the environment in which you're having to operate might develop, and what can you do about it?
It's a great question, Jonathan. From our perspective, our job as investors is to look through the noise. So we're not going to be switching over our portfolio, but this is clearly a much more volatile environment that we've seen in the past. But for a portfolio like ours that's designed to be diversified and also resilient, it's set up to be able to perform in this kind of environment. It's a very different environment than 7 stocks driving more than 50% of the index returns. So if we look at the complexion of our portfolio, we're diversified by geography. So close to 55% of our assets are based in the US, but the remainder are based in Europe as well as Asia, which have been long-term structural themes for us as a firm. On the public side of our business, as markets continue to broaden out, given we've had a very significant underweight to Magnificent Seven, that's naturally a positive for us. Last year, we were able to generate in our quoted equities book a return of 15% with very minimal exposure to Magnificent Seven and technology stocks. So we view that as a positive catalyst. And in many ways, we also have our China exposure that in the first quarter of last year, China was trading, in our view, at much lower multiples than historically. So it looked quite cheap. So we looked to add to a bit of our exposure at that time. After the new administration was elected, our view is that Europe would start to look quite promising. So we added to our European exposure. So our job is really to look to identify some of those trends which will look to play out in the market later in the year. But generally, our equity allocation is more, it's about 45% of our portfolio on the quoted equity side. So it's relatively in a more neutral position. And then we have diversification by geography, as well as investing in uncorrelated strategies in places like credit and absolute returning strategies. We also have a certain element of gold in our portfolio.
So you measure your performance primarily against 2 benchmarks, if you like. One is inflation plus 3%, I think. So 3% real return, and also 50% split dollar sterling all countries world index. So you made 9% last year. Do you regard that as satisfactory or less than satisfactory or brilliant? How would you characterize that performance against your objectives?
I think, Jonathan, anytime someone's going to ask me that question, the answer is, of course, we'd obviously love to do better.
Okay, so does that imply that you made some mistakes last year, or is it just that you, like many, many others, are not willing to chase the US market higher, essentially, in those concentrated names?
So in those concentrated names, if we look at our index, which you referenced, if we equal weight that index, the index returned 10% last year.
Yeah.
So we're not going to chase those names or flip our strategy. We think about the world on a long-term basis and how we're going to compound returns for our shareholders over the long term.
We know that Donald Trump wants to reduce the value of the dollar. How do you factor currency movements into the way you manage a portfolio? Obviously, your benchmark is partly split between the dollar and sterling, but how do you deal with that, and how effective did you manage to deal with that last year?
So last year, currency had a minimal impact on our results. It was roughly about 30 basis points. And we tried to maintain a neutral positioning on the currency. So we will hedge to a degree, to a more neutral positioning, with the view being that if we don't hedge, then we're taking a very large active bet for our investors, and we don't want currency to swamp our results one way or another. So we take a more neutral view on that front.
So in terms of the shareholder base that you report in sterling, effectively, what's the kind of currency wishes of your shareholder base, if you put it that way? Not to take any risk at all on the currency front. Is that right?
More or less, our shareholders aren't anticipating that we'll be generating meaningful plus or minus returns from currency. Our shareholders are looking for us to generate returns from our 3 primary strategies, while at the same time minimizing currency risk, which is what we do.
Can you tell us what lessons you took away from being a senior manager at the Canadian Pension Fund? I haven't followed closely what they did, but do they follow the traditional kind of endowment type approach, multi-asset obviously, but what kind of lessons could you bring from your experience there to the management of RIT?
So they do follow more of the endowment model, which is actually akin to RIT as well. The opportunity I had at OTPP was very much to be a global investor, investing across multiple asset classes with the view that being consistent in your approach, having a repeatable process is absolutely needed in the everyday of what you do.
But I guess what I'm saying is it possible to replicate that kind of model with a much smaller asset base?
The asset base doesn't matter. And actually, in the case of RIT and the brand, it opens up the same opportunities. Most of the investment opportunities that we have in our portfolio are not accessible to the individual investor. Most of our partners or our specialist funds are largely closed to new investors. And that's what we're really looking to offer our shareholders.
Sure, and that's always been one of the attractions, the kind of network that Lord Rothschild built and the access that you've developed over many years as a team. That should give you an advantage, which I think is one of the reasons why people would invest in RAT as opposed to some other vehicles. And I guess that's what you need to convince people that that still works, if you like, even though Lord Rothschild himself is no longer obviously with us. You'd agree with that?
So to be clear, Lord Rothschild stepped down from the board in 2019. And the firm as a whole, as you can appreciate, had been preparing for his departure and really moving into a more institutional firm over that period of time. And that's also what I bring. But he had stopped managing the firm in the day-to-day from 2019. And as an institution grows, RIT has more than 35 years of incredible history, and it's more of an institution, and that can carry on for hundreds of years as long as you've got a solid team behind it. And that's what we continue to do. And the brand continues to open many opportunities for us. Going back to the comments on access, we did one investment last year that I do think demonstrates our access, which is SpaceX. The bar continues to remain very high for us to make new investments, and we'll only do that in exceptional companies. And SpaceX is one of those companies, a company with high free cash flows, high margins, very strong growth, and a market leader in their own right. And as you look across the RIT portfolio, you have SpaceX, and in that class, you also have Stripe as well as Epic Systems, very strong compounders of growth for the long term.
And you're not worried that the CEO or the founder of SpaceX is busy on so many other things at the same time?
He has an excellent management team, including the CEO of SpaceX. So that company has a very strong team leading the company.
So can I ask you then about the buyback program and so on? You said you bought back 7 or 8% last year. Do you have a target for the discount, or how do you decide how much you're going to buy back? Obviously, at 28% discount, you'd think that there would be scope for you to do some more on that front. So how do you approach that? What's your criteria? And given that the discount's still at 28%, are you doing enough?
So we continue to buy back our shares. The discount is top of mind for the board, for the management team. And as you've seen, we bought back 8% of our shares, and we will continue to buy back our shares. And if the discount is in the high 20s, as we've seen in recent weeks, you've seen us stepping up our buyback program, and we'll continue to buy back our shares. We view the buyback as a capital allocation decision, and at these levels, we see it as extremely attractive.
Indeed. But is it your aspiration to get it back to a premium or back to par? Or would that be too much to ask for, given that you still have these private investments? And very few listed private equity trusts have ever traded at very narrow discounts, with yourself as perhaps one of the exceptions.
And I think the idea, Jonathan, is to return to the exception.
You're not lacking in ambition. I guess that's how one would put that if you were liking to think about what you're promising to achieve.
We have traded at a premium in the past. We have looked to explain our privates portfolio to the market. We've had a number of realizations, including the start of this year. We've had a realization in a directs portfolio in a company called Zappo at a very strong return. We've recently seen the announcement on Wiz, one of our companies that was held through our funds portfolio, in a company called Service Titan, also IPO'd in December of this year. First day of IPO, the stock was up 40%. So we've got a very strong portfolio of private assets that will realize returns for our investors.
So to sum up then, if you wanted to convince me to have a look at investing in RIT Capital again, I used to be a shareholder but got a little disillusioned, what would you say?
Well, I would say at today's discount, Jonathan, it's an exceptional opportunity at a very wide margin of safety. I think what we've been able to demonstrate is that the fund has demonstrated strong returns last year. We continue to build on the momentum and look to continue to address many of the concerns that came up through 22 and 2023. And we've got a very exciting suite of investments. And in this environment where you have more volatility, what you want as an investor is diversification. And that's exactly what we provide our investors through an opportunity set and portfolio of investments and specialist fund partners or direct investments that can't be easily replicated elsewhere.
Because I guess what I would say to that, just sitting where I sit, is that the thing one used to be able to rely on with RIT, or at least thought we could rely on, was that you wouldn't get very dramatic drawdowns over the course of your holding the shares. And obviously we have seen a significant drawdown in terms of share price performance. I agree that NAV is slightly different. And I guess people are looking for reassurance that that is front of mind for the trust and for the board, and for you, obviously, in a way that perhaps people think it may have just lost sight of that for a while.
No, I think it's always been top of mind for the board and the management team, Jonathan, and everyone is a shareholder and very much aligned as shareholders in the company that needs to be addressed. And as we've been speaking, that's really what we are looking to do. The initiatives around meeting with investors, providing additional transparency, and continuing to demonstrate confidence in our portfolio by buying back our shares, and then obviously delivering on performance is all aligned to that very point, which is to improve the share price performance. But it's all connected.
It's all connected, I can see that. And indeed, it's all, as you say, a little bit about the brand as well and how effective that is. That was a key part of the brand as far as I was concerned, along with obviously the historic performance, which has been excellent. Very good. So that was Maggie Fanari, the CEO of RIT Capital, the 2.7 billion market cap investment trust. Currently trading at a 28% discount, but hopefully, as she would have it, heading higher soon.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.